And I'm excited today. It always excites me when I get a new speaker in the room that I haven't heard before. I know Hubert knows Mish pretty well, but I do not. So today she's going to be joining us. It's very rare to find a woman in the markets that'll come on here and tell you what she's doing, and we're thankful to have her here today. I'm going to go ahead and give her the mic. She has 1 hour, and I'll let her share her screen. Let me go ahead and give her presenter status and make her the organizer so she can see your questions. And can we get a sound test? Are you there? I see you're here.
Hi, Jeanette.
Hey, how are you?
I'm good. Really nice to meet you.
Nice to meet you too. I'm so pumped that you're here. So can you see the questions and everything? If you use GoToWebinar, you feel pretty comfy?
Yeah, I'm very well familiar with it. So,
Great.
yeah, thanks. And thanks, Hubert. It's been a while since we've hooked up. I think last year I actually did something with you guys. So, anyway, welcome, and certainly congratulations to those of you who are still tuned in after all those fabulous speakers. I'm going to actually do something a little bit different than what all the gentlemen that preceded me did. So I wanted to give you a little bit of a background on who I am, because I'm assuming most of you don't know who I am and who Market Gauge is, and tell you that the topic that I'm going to discover today with you, something that I have been teaching and trading with for a very long time, is phases. And it's very, very simple, extremely fantastic way to get started. If you're new to trading, and even if you're experienced to trading, which I am, it is a great reinforcement of how simple things can be. Because you know we've gotten very complex. You listen to a lot of different people, and layers and layers and layers can be added to trading, and this really brings it back to the basics. So that's why I like doing this so much. Now, this is just a disclaimer. I'm not going to read it, but basically it says that, you know, whatever past performance doesn't necessarily guarantee future performances. You should never trade money you don't have, and of course you can lose everything. So hopefully I just met the SEC requirements in saying all of that. So now this presentation, it looks like I'm talking about myself in the third person, so forgive that. But this is me, Mish Schneider, and just to give you a little background, I started out as a member of the Coffee, Sugar, and Cocoa Exchange in New York. I traded NYMEX for a long time. That's oil and gas. I traded the metals. I started out as an analyst for Continental Grain, and then I worked for Conti Commodities before I became a local. But dispersed before and during, and still I have a master's in special ed, and the reason why I bring that up is mainly because the bulk of my experience has been modifying curriculum in the school districts for kids with special needs, which basically means that I can teach and trade, and I try to use my special ed skills, because let's face it, when it comes to learning something new, we all have some level of special need. And so I try to make this as fundamental and as clear and as multisensory as possible so that you can all pick up a good information. I've been doing this for 30 years. MarketGauge.com is our company, and my title is Director of Trading Education and Research. I will talk more about that later. And I'm also a partner in Market Gauge Asset Management Company, which is an asset management company that trades all different models that we have. So let's talk a little bit about what you're going to learn in the webinar. So this is really basically a swing trading model, but it can be used on any trading time frame. The whole idea is to be able to figure out, and especially, you know, after coming from a great bull market that made everybody look like a genius in 2013 and 2014, this year has been obviously a lot more difficult. So there is a way to be able to get in, long or short, understanding, and you're going to learn more about that, a couple of moving averages, and then really knowing how to avoid painful losses and catch a swing trade when it sets up. And so the whole idea is that I hate to lose a lot of money, and so this is really about limiting your risk, because you understand very clearly where you are. It's a picture, how to use the stops and how to lock in money, and it doesn't really take a whole lot of time. So This is a little bit of a throwback here. This is when I was down on the commodities exchange in coffee, sugar and cocoa. You can see a young girl there. And what I'm holding in my hands you see on the right, and that's a point and figure chart. And the reason why I like to put this picture up is for two reasons. One is because I did start out as a school teacher. I don't have any fancy degrees from Wharton School of Business like Donald Trump. And I basically came from a very low middle class family. My dad was a mailman, and I had learned about the markets through a neighbor of mine in New York, and she brought me down to the commodities exchange, and my head exploded. I really wanted to be there. So when I say break through any limiting belief, I never thought of myself as just an anything. I always wanted to try something new, and when I saw this, I knew I was totally hooked. And so I learned point and figure charts, and that's the second point. I would actually carry around and make X's and O's, whatever particular commodity at that point I was trading. And from that, actually, two things occurred. One is I really got to see how chart patterns emerged on a day trading basis, which is how I started really, was day trading. And two is using that tactile experience, which none of us have anymore really because everything is electronic, but what it did was gave a kinesthetic sense to the market, so that as I was actually using my hands to draw, it brought in another way for me to really feel the market. And even though this is so many years later, I still actually can sense the market tactily just from watching the ticks on the charts. So let's talk about the three basic secrets to catching these swing trades. Now, obviously, it's always good to trade when the market is easiest to trade, which is why most long-time traders will tell you that it's easiest to make money in bull markets. But that doesn't mean that you have to wait for a bull market. What you really have to understand is that the trend is your friend. I know it sounds like a hackneyed phrase, but I can't tell you how important that is, and we're going to show you as we get into this. And when the whole market is trending in a certain direction, of course it's easier. But it doesn't necessarily mean that you have to have the whole market trending in the same direction, because as we know, those of you who are familiar with trading, things do go counter-cyclical. And I'm going to talk a little bit about that later. And so this is really all about understanding how to time your way in and out. And it starts with the phase. I've taught this webinar to thousands of people. It's really easy, and the reason why I'm even doing a book on this right now, it's called Phase Not Confused. It'll be out sometime next year. It's really understanding how to know what things are and where things are without having to listen to anybody else to determine what that means. And that's the whole thing. There are lots and lots of people out there who will tell you what to think, what to do, what's going to happen. To me, I've always wanted to make my own decisions, and I also encourage everybody else to make their own decisions. But in order for you to make a decision, you have to have some roadmap, and that's what this is. I put this up because there's really a couple of reasons why I do this. One is I really love to teach. Obviously, that's why I'm here today, and that's why I've been doing this for years. Two is I love the feedback that I get from being a calm, patient person. I do come with a different perspective, having been a floor trader, having been a teacher, and being a woman. Definitely women traders come to the markets with a little bit different perspective. We tend to be less, we're certainly less risk averse, I should say more risk averse, excuse me, and we definitely understand value innately. And so I talk to a lot of women out there about when they say to me, gee, I don't really understand the markets, I'm scared of finance, and I try to tell them that actually, naturally, as typically the people in the family who control the budget, who do the shopping and look for value, we do. And that's what these commentaries always come back to me as, is how much they've learned. So let's start. Phases are absolutely scientifically proven. Why? Because everything in life is cyclical. The life of a plant, our lives, and the same thing with the market. And what makes the phases so interesting is if we start on the top of a cycle, or what I call high noon, which is the bullish cycle, eventually you can guarantee that a cycle will complete. The question, of course, is how long will it take and when does it happen? But definitely, this is a great time to do this webinar because in the past, for the last several years, we've been in this bullish cycle, and now I can prove my theory out because you'll see that obviously now we've gone from that bullish cycle into a bearish cycle. So what happens with a bullish cycle, and this is what happened really basically throughout the spring of 2015, is the market, when I call about the market, I'm really speaking of the forward indices, went from bullish to warning, bullish to warning, bullish to warning. So right away that was a sign that that type of erratic behavior, some sort of sea change was coming. And clearly we know that it did. So once we get into a bullish phase, eventually things start to wane. We go into a warning phase. They deteriorate further. We go into a distribution phase. And then things get really bad and we go into that bearish phase, which is where a lot of instruments are right now. But one of the greatest qualities of human nature is our ability to have hope. And so eventually things do improve. And this happens to be my favorite time and what I always look for. So if it's not in the overall equities market, I begin to look at it in the commodities market. And by the way, this works for everything, whether it's Forex, commodities, options, ETFs, you name it. Everything has a cycle. And eventually what's bearish starts to recover. Then things get more optimistic, we go into accumulation, and then there we are back into a bullish phase. So it's a great cycle to follow, and it's really fantastic, almost like a GPS system, in that when you know where you are in the cycle, then you know how to make certain decisions, not just about trading, but about a lot of different things. Essentially, you know, should I be borrowing money from the bank right now? Should I be buying a house? Hey, I have a kid, and I'm not sure what he wants to study or she wants to study in school. What is trending in a positive fashion, like a semiconductors back in 2012, which was ready to explode? Maybe I should direct my child into studying something in that area. So phases are very, very informative. Now, let's start with how do we identify a phase, and we'll begin with the bullish phase. So I use two very simple moving averages. And these are simple, they're not exponential moving averages. One is the 50 and one is the 200-day moving average. And that's it. And of course I use a lot of other layers like most other traders do, as I've been doing this for a very long time. But I want to emphasize that really, if you look at a very simple bar chart or candlestick chart and you just plot in these two moving averages, which any charting service has for free, so it's very easy to access, then that's really all you need. And if you're extremely patient when things set up the way I'm about to teach you, they need to, you can make some really good trading decisions. So what's important about the 50 and the 200-day moving average is the position that they have to one another and then their slope. So, for example, in a bullish phase, if this is the 50-day moving average and this is the 200-day moving average, that's what needs to happen. The 50 has to be above the 200. And in order to measure the strength or the momentum of how good that bullish phase is, if the slopes are pointing up in both of those moving averages, then you know the momentum in that bullish phase is increasing. Then, of course, you have the price. So you want the price to be above the 50 and above the 200-day moving average. Now, what's ideal is if the price is right above one of the moving averages. In this case, it would be above the 50. And there are other ways in other phases I'll show you when it's above the 200, but not quite over the 50, which is also valid. But the idea is you want that price to be as close to the moving average as possible. Can anybody guess why? Well, it's all about risk. Yes, institutions, I see Laurel making a point there, and we'll talk about that in a second. When you are close to a moving average like this, then you know that if the phase is good, it should hold this 50-day moving average, and daily moving average is what a DMA is. And if it holds this 50-day moving average, you're golden. Most likely you're going to get momentum because, as Laurel just pointed out, institutions are all watching these same moving averages. They watch the 50 and the 200. In fact, as I've been writing this book and doing research, I saw that Paul Tudor Jones, everybody knows who he is. I actually used to work next to him down on the floor back in the day. He watches the 200-day moving average, and he will make his major moves based on whether something is clearing above the 200 or failing the 200. So if you're close to the 50, that means that if it fails the 50, guess what? Without any emotion, without any hope, without any fear, you just get out and you reevaluate. So in the same moving averages, if your price is all the way up here, let's say you weren't really paying attention to something, you read something on Twitter, in the news, you watched on TV, you got a newsletter from somebody and they said they like such and such a equity or currency or ETF or whatever it is, and you pull up a chart and you see it's in a bullish phase, you say, oh wow, Mish taught me that. This is the 50, this is the 200, they're sloping up, the 50 is above the 200, but darn, this price is all the way up here. That means what? Now you have a big risk in any market correction, which happens no matter what the condition is, whether it's in a bearish market or a bullish market, and now all of a sudden you can lose a lot of money on the way down. So you don't want to do that. In that case, I'm not saying you don't have a good day trade or a 2 to 3 day trade, but for any kind of hold swing trade, you really want to wait for that patience to be set up for the moving averages to line up and the price to be close by. Now, I will say quickly that in a bear phase, it's just the opposite. Here's your 200, here's your 50, so that's your 200 right here. That's your 50 right here. So the 50 is under the 200 and the price is underneath the 50. So that's a classic bear phase. Now just to kind of apply it to some charts here, you can see that I purposely took out everything except for price, obviously the months and the years. This is a candlestick chart. I like to use it. I love candlesticks actually, but that doesn't mean that a bar chart wouldn't work as well. I think the idea is consistency, so whatever you're used to. But the point is that this is the bear market that happened in the beginning actually at the end of 2007, with the bull market starting in the beginning of 2009, or I should say more like the spring. So here we go. The blue line in every chart I'm going to show you, the blue line is the 50-day moving average, and the green line is the 200-day moving average. Simple moving averages, guys. Nothing else in here, right? I'm really, really into this back to the basics thing. That doesn't mean that I won't advocate layering other stuff as you get more advanced, but for the very simple identification, I'm telling you, this is all you need. Now, in 2007, right at the beginning of 2008, this is what is called a death cross, very aptly named. The 50 crosses below the 200. Now, this is exactly what I'm talking about. It was going up and down around both the 50 and the 200-day moving averages. So it was actually changing phases from bullish to warning to distribution, back to warning, back to bullish, and then bam, it broke down, went into this bearish phase, and look how neat. If you were going short, and a lot of people don't like to short, but if you were a person, and I have people who just sit around and wait for short opportunities, never like to buy, and conversely, I know people who will just sit out markets when they're going down and go to cash. Well, either is a valid thing to do, whether you want to trade the momentum to the downside or just get the information that says, something's rotten in Denmark, I better go to cash. Know that at this point you have the tightest risk because all you have to risk is to right above the moving averages, and you can see you made a great trade when it went down. And again, as I mentioned, in any market you always see corrections. So in a bear market they call it dead cat bounce, but they always happen. This one was a rather vicious one. But again, if you waited it out or you got out on the way up or you bought on the way up and it didn't clear this 200, you had another great opportunity to sell. And even though it faked out and you might have gotten chopped up a little bit here, just trading that phase, this is right here called a recovery phase. Eventually, you could see you made tremendous money to the downside. If you sat out in cash, you were waiting for the opportunity. And remember, but I told you about slope. So look how nice. The slope is down here. The slope is going down in the 200. Look how sharp the slope is here. And then here we go. In April or May of 2009, the market gets a classic V bottom, but what happens more important to what I'm teaching you, which is the price goes back above the 50, and look what happens to the slope. It starts to neutralize, it eventually goes up. As we got into June, July, we had a golden cross. And look again, you had an unbelievable buy opportunity close to the moving averages, and then you can see that the slope started to accelerate on the 50, the 200, by the way, which is a slower mover, obviously, because it measures over 200 days as opposed to 50, but that also eventually started to go up, and it hugged the 50-day moving average, giving people a lot of opportunity to get long as the market started to recover. Now, the other thing that I've come up with this year, and one thing I will mention, is that if you want to follow me on Twitter, in fact, I'm going to put it in the chat box because I talk a lot about this on Twitter throughout the day, and that is, my Twitter handle is at Market Minute. And that is a great way to hear about the modern family, and then also read my daily. I do a daily blog every day. It's called Mish's Daily. It's free. It covers the main markets. It gives entertaining commentary, a lot of metaphor use, and also gives you specific ETF recommendations every single day. So if you go to @MarketMinute, you'll be able to get the link. If you go to Market Gauge, you'll be able to find that as well. And we have a lot of free content, actually. And one of the things that I came up with this year was the idea of the modern family. And that's just my way to kind of give an image to what the market is doing as a familial unit. So getting back to what I mentioned before about when things are trending all together, of course, that's always the best scenario, but you can get information when there's diversion. So let's talk about my modern family here, and I think you'll understand more once I go through it. I've chosen one index and 5 sectors and groups. And so IWM is the broadest index because it's the small caps, 2,000 stocks. So I'm sure this is repetitive for a lot of you, but you know the S&P is the Fortune 500 companies, the NASDAQ are the top leading 100 stocks, the Dow is the 30 blue chip stocks. So the IWM with its 2,000 small caps, I think cleans up a lot of noise because you can get the best indication of what the U.S. economy might be doing based on these small cap stocks. So I happen to be a big proponent of watching the Russells. In my modern family, I have named the Russells, partly because of the name Russell, Granddad, because I do believe that he is, or it is, the granddaddy of the entire market. What that is doing, ultimately, whether it's leading or whether it's lagging, becomes a key barometer and forecaster of what's going to happen with everything else next. Then I have Grandma. Grandma is retail. XRT, that's the ETF symbol. GDP is 70% made up of retail. It's the consumer market. It's the consumer sentiment. It's what drives the economy. Those of you who were looking at yesterday, the sentiment came in lower, and the retail sector, of course, got hit first. Along, by the way, if you were trading yesterday or watching yesterday, the Russells. Everything was green. The diamonds, the Qs, and the SPYs were green. Russells were red. Now, part of it was ex-dividend, but it was still going down in a greater percentage to what it should have based on ex-dividend. And, of course, eventually what happened yesterday, even though the Dow closed up, a lot of things sold off. Then I like to use IYT. IYT is the transportation sector. Dow, back in the day, his theory was that you watch the Dow Jones Industrial Average, but you also watch the transportation average because, let's face it, what moves this country and its economy is how goods and services are being delivered. So trucks, planes, automobiles, all of that is encompassed in the transportation sector. And if that's not doing well, and you have affirmation that retail's not doing well, on top of that Russells are doing well, guess what? Nothing really is going to hold up for too long. Finally, not finally, but I also have regional banks. Now, regional banks symbol is KRE. I started following this one a while ago, And regional banks are an excellent measure of the economy in the United States. And I'm talking specifically United States economy as the major global economy. And so if people in communities are putting their money in community banks, that's a good sign. It means that people are actually interacting with their bank, whether they're borrowing or saving, and that's a really good measure. And actually, interestingly enough, and you're going to see all of this momentarily, KRE has been outperforming the rest of our modern family. And then I've added two speculative instruments, biotech, which of course has been the big buzz since Hillary Clinton made her comment a couple of days ago about big pharma gouging prices. Of course, we know that's true, but nonetheless, as a speculative instrument, not necessarily a measure of the U.S. economy, but highly speculative, you get a really good sense of what the investors are doing. So I call IBB Big Brother, because Big Brother was carrying the market for a very long time, and now IBB has been declining quite rapidly. So again, you have a measure now to show you that speculative investors' sentiment has been waning. And then finally, we have the semiconductors. Now, semiconductors are speculative in nature and not necessarily as good a measure as retail or transportation in terms of the economy, but semiconductors are definitely a good indicator of the health of the technology sectors. And so that too has made my family. So now let's take a look at how all six play together. And this goes back to the phases, so I'm going to tie it all in now. Now, somebody did ask, I happened to look over to the questions, and I can't wait to answer your questions, but I really would like to kind of finish this all up first, so you have the whole educational piece of this, and then we can talk about the specific questions. But the blue line that you see, the light blue line, one of the comments I just saw people ask, well, is a 10-day moving average? And the reason why I have that in there, I'll show you later, because I often use that as a way to indicate when I should take profits or when I should get out of a particular trade. So here we have all six. We start with retail, biotech, Russells, semiconductors, transportations, and regional banks. Here's your 50-day moving average, and you can see sneaking down under here, here is your 200-day in all of these charts. So again, my purpose is to show you how simple it is using just bar or candlesticks, two moving averages, and this one we layered the third. The reason why the gray area is here is so that you can make a guess along with me what might happen next. And so the period of time is not even disclosed here. You just see the month but not the year. So if we go to Granddad right here, what do we see? We see that it's in a bullish phase. Why? Above the 50-day moving average, and although you can't see it, the 200 is down here. You can see the slope is up, but it's sitting right around here. So we're wondering, what might IWM do next? Well, KRE is still under the 50. This transportation is sitting right above the 50. But look what's happening to biotech. Speculators are still mad for this particular sector, and so even though it had tested the 50-day moving average down here, look at the move it had made off that 50-day moving average. And semiconductors were not doing as well. I'm sorry, here semiconductors, but they were moving up, and the same thing with retail. So you have two decisions to make. You have to say either I think that IWM is going to play some catch-up along with KRE and IYT and follow these three sectors leads, or this is dragging the market down and this is going to actually top out. Well, in this case, considering you had strong upward slopes, the guess would be that there would be follow-through. So here we are just a little bit later on, and you can see that the IWM starts to move up, biotech starts to move up even more, retail, semiconductors blasts off too. Here's your IYT now making a big move off the 50, and we're still sort of struggling a little bit here in the regional banks. Probably my guess would be something to do with what interest rates were doing at that particular point. If we go just a little bit later on, now retail is starting to consolidate a little bit, biotech as well, but IWM wound up with a 5% move. KRE started going. IYT started to sell off a little bit, was hanging in there, and semiconductors were also starting to consolidate. So the whole purpose of this is to show you that when things are trending together, it's good. When everything is in a bullish situation, it's good. But you also can see how the relationships work with one another. And clearly, if you're watching The Modern Family, you want to follow the one that has the tightest risk, but you want to use the information, that one that has the greatest momentum, as an indication that things are going pretty well. So things started to consolidate that 5% move, and then everything started to move up, and we eventually peaked out, and that was the end of the bull move. But you can see that as this was consolidating and breaking out, KRE was really doing well, and the rest really didn't actually break out as great. Retail did a little bit, semiconductors a little bit. So at this point, you're going to have to say, gee, you consolidated, I want to get back in, but maybe I should be watching these other things to see if they start breaking down under their 50. And you can see that things go up and down around that 50. This is exactly what I mentioned before, that this year in particular, and that's what this is from, we started to see that erratic behavior up and down around that 50-day moving average. So let's go on to a different time. Now this is more recent. This is before the plunge. Now let's look at the same 6 charts and the phases again and see what information that was telling us, that was really telegraphing, like a map. You're lost. That something was going to happen that was not going to be a good situation. And again, obviously, I don't need to listen to the news. I mean, I don't even watch the news, actually. I watch Twitter. I subscribe to about 20 different news services. I read headlines. I don't want to know what anybody is thinking, really, because after doing this for so many years, I've got to tell you, I can see everything that I need to see right here, and that's all I need to know, other than how much to risk, what kind of reward, what kind of position sizing. We'll talk about that in a little bit. So let's start with Granddad again. So now look what's happening. So I mentioned to you that if it breaks the 50, it goes into a warning phase. The slope was still relatively neutral, so it kept going back and forth between the warning. It took out the 200 for one day, then came right back. But you could see now what was happening as it was starting to bounce. This was starting to slope down. The 10-day moving average was accelerating down as well in all of these. IBB was still hanging in there with a positive slope and still bullish. Retail was also starting to slope down, hugging that 200. Semiconductors, look what happened. It was just about to get the death cross. It broke the 50, it broke the 200. And even with these bounces we were getting in the others, it was still very weak. IYT was still hanging in there, and regional banks were now breaking down under the 50, but the 10 was crossing below. And again, these slopes that had been really strongly to the upside were starting to neutralize or to go down. Is this a good, fair warning? Do you need to hear somebody on the radio, TV, or even on Twitter tell you that the market is going to go into a correction? No. At this point, you either try to set up what you want to hedge if you're very long, you want to get out of some of your longs if you can, and maybe even look for the opportunity to go short. So, oh, here we go. Here we are days before the plunge. So this is a little bit later than the scenario I just showed you. Everything now is negative. Death cross, death cross. Not quite a death cross yet, but certainly declining. Death cross. Also looking like it's coming to a death cross. This had happened already. IYT was actually, besides semiconductors, the first to break down. Once that broke down, that told me that everything else could follow. IWM certainly was now under the 200. But again, in terms of understanding the phase and seeing now that a lot of these instruments were bearish, with the only two holdouts, these two, which interestingly enough are still holdouts right today. They're still in distribution phase, not in full bearish phases. They could get there. IWM went right up to the 200. It tried for a few days to break it. It couldn't. Look at what a great short opportunity you had right here, or at least, like I said, a heads up. that maybe you shouldn't be buying. That doesn't mean there weren't instruments going counter, but in the overall market, it was certainly transmitting warning, warning, warning. And then we had that big crash. So that was number one, is understanding when the market is easiest to trade. So those two simple moving averages can show you when everything's bullish, like I showed you in the first examples. And I like to use the Modern Family for the reasons that I just mentioned to you, but again, this works for anything. It's just that I find to really understand, to become sort of my own economist without having to listen to economists necessarily. That doesn't mean I don't, but generally, timing your way in and out of markets, listening to economists is not a good formula because they're often 6 to 8 months behind of what's going on in the market at the time. So this is your sort of way to be a quick economist, make an assessment, and see what you want to do next. Number two is really being able to now focus on trading those phases when they are actually happening. Why? As you can see, it's probably the most explosive time. You should get follow through. It's very easily defined, and the risk is very low if you're close to the moving averages. And as Laurel pointed out before, institutions, this is what they are watching. So what I want to do now is I want to give you, these are all real trades. This is all part of a service that, one of our services that we run, that I run, is called Advantage. And so Advantage is, we'll talk more about that later, but it's a service that basically is twofold. One is to reinforce all the education I'm giving you now about when things are changing phases, etc. But the other is also to give you a real trading example, a recommendation at the time that you can follow on your own if you wish to trade it, paper trade it, or just track it in our model portfolio. But more important is for you to understand how the patience factor of knowing when something is actually changing phases and getting in at that time in the direction of the phase really is a fantastic way to consistently make some money. So here's our blue line going down. That's our 50 going down. But the 10-day moving average, and that's why I like to layer it in. It's not necessarily the most important thing. As I showed you before, you can use only two. So even if you waited a little bit, you probably would have missed this move up because you would have said the price is too far from the 50. So I got in here in anticipation that this was going to hold the 50. I like the risk right here to right under the 50-day moving average. And you can see the idea is not, oh, gee, how smart is Mish? But the idea is that this is a very simple way. This is about the simplest thing that I can imagine teaching on how to find these great moves that are about to happen with a very minimal risk. This happened to be junk bonds, interestingly enough, which had been depressed for so long. Recovery phase is when something, the 200, by the way, was up here, is when something is crossing back over the 50. It's called the recovery phase. I showed it you on the graph. It's the hopeful period after the bear phase. That's why I like it. I like to catch the beginning of a hopeful period because what you really want is to see hopefulness contagious. And very often it is. Everybody likes to jump on when things are going well, and that's why we caught this move. So 5 ATRs, what an ATR is the average range of an instrument. And you can see that right here, the average range of junk bonds is very small. It's only 15 cents. So it's not a big mover, but we got in here, we sold some here, and then we exited here. That's really my favorite use for the 10-day moving average is if that breaks down and it starts to slope down, usually that tells me maybe the move is coming to an end. And especially if I'm buying in a recovery period as opposed to a bullish period, because you can just get this big old bounce and see it break down back under the 50. Mosaic is another example. Now this one, you had a couple of opportunities to get in. This changed phases twice in 2 days. Now that's highly unusual, but I really, really liked this one a lot at the time because it got back into a recovery phase. You can see this 50 is underneath the 200. It had been in a bearish phase. Now I could see that it was dancing here on the 50. I had a really good clean risk. The 50 was starting to slope up, so all of this is very consistent. The 200 was sort of neutral here. We got in, we risked down here, and this was one of those amazing moments in time because it gapped higher above the 200, changed phase to an accumulation, took some profits. I have parameters for taking these profits, wrote it out to here, and got out, maybe because of earnings. Now Russia, and so this is, I wanted to give you a good blend of RSX and some of the smaller ETFs that I trade and then some of the bigger stocks that I trade, because again, I really want to prove to you that you can do this with any instrument you want to trade, whether it's a small one, a big one, whether it's a cheap one that trades only $5, or something super expensive like a Netflix that is trading well, now it's split, but at this point at 100, but at one point at 700. So here is Russia. This is the Russian ETF. And again, I tracked this thing. It broke back over the 50. But sometimes when I finally clue into something, it's all the way up here, and I'll say, missed the boat, never mind. But then I'm watching it, and I see it corrects all the way down to the 50. So this is when I like to strike. I'll give it a couple of days to make sure the 50 is going to hold, but look at that slope I was telling you about. Meanwhile, the 200's all the way up here, so we're still relatively negative, but we're getting into recovery. And we got long, we risked under the 50. Again, we took profits along the way. We actually were excited to see it break over the 200. And then when it started to break down under the 200, guess what? I got out. As this was going into a bullish phase, we were already out because we caught what I thought was the best of the move. And this bullish cross was just happening once the prices were under, so it negated my desire to get back in. Here's another one. This is solar energy. This happens to be just one of my favorite ETFs to trade. I was very, very bullish at the beginning of this year in solar. Obviously, over a long term, we could still be bullish in solar, but right now it's been pretty hammered. But again, I waited for it to go into a bullish phase. You can see the slope was starting to neutralize, started to point up. We waited for that. We got in here. Then it changed back over the 200, and we're already, as everybody else is saying buy solar, we're already starting to take profits based on those phase changes. KRE, here's my prodigal son in the modern family. Obviously another one that I love to trade since it is in the modern family and also has continually outperformed so far in 2015. This actually goes back to 2014 here. And I also really like when things are consolidating around a moving average, because that definitely gives you an idea of how clean your risk is. But same thing, consistency. It had the golden cross here, but the price was too high. I waited, got in just as it started to dance around the 50 with a risk under here. Started to move up. I was patient. I got out of some of it here, sold some of it here. And at the time when we made this, we were still in this thing. We rode this all the way up to about 46 and got out. This trade I am no longer in. This was a while ago. PBF is another one. Again, this is really more about timing. Now, in this particular case, this would have been the better time to buy right back here when it was closest to the 50 and had gone into a bullish phase. I decided to wait after I saw this correction, and again, I may have not even been paying attention. I look at 500 and something instruments every day, so I'll often miss something. If I miss it, I'll continue to track it. If it gets too far away from me, I just won't take that trade because there's something else always lining up. So I waited for this period of consolidation. It still wasn't too far from my 50. Again, got in, got out when it started to break down after making new highs, and you can see what happened there. Now, the third one is about keeping your stress levels down because you scale out of these trades. I use specific targets. I'm not going to have the time to get into what those targets are now. But suffice to say that once I start to get momentum, and I'll use a multiple of the range of the particular instrument. So if we're talking about something like junk bonds that had a 15-cent range, I'll wait for 3 multiples or 45 cents profit before I start taking a target. And at the same time as I'm looking for these multiples to get my profits, I start to trail up my stops. So when I get 2 times the multiple of what that instrument is, I go to a no loss, so that this way now I've locked in. I can take some profit, but if it starts to go against me, I'm not going to turn a winner into a loser. As the market gives me, or my instrument gives me, the momentum I need and it continues to go, I start trailing up my stops. And when I first get in, I always think to myself, if this phase is a fake out and I wake up tomorrow to a gap against me, how much pain am I willing to take? Well, you can't ever really assess that because otherwise we'd all have crystal balls. But what you can do is you can position size and assume that worst case scenario, if you're going to get a 1%, maybe 1.5% move gap lower. And that's really only happening now. That wasn't even happening up until recently. This was a year that had a tremendous statistic. The S&P 500 hadn't moved more than 1% one way or another for a really long period of time. Volatility's only picked up more recently. So for the most part, and even in the most anomaly type situations like we have right now, if you can position size to know that if something goes down 1% or 1.5% against you, that you will only lose X amount of money. And what I like to use is about 0.5% per trade of whatever your overall equity is. So that means if you're trading with 100K, you're going to risk $500 on any given trade. All in, if you're fully loaded in your portfolio, you probably shouldn't allow yourself to lose more than 4 or 5% if everything goes to hell in a handbasket. So let's look at a couple. Well, this is one more winner I just want to show you. JetBlue, by the way, this is where you take a stock like JetBlue, and I started trading this, by the way, at like $6 or $7. I've been in and out of this now for the last couple of years. So once you find something like a company that's really going to continue to do solidly like JetBlue has. And by the way, the story of this, and I say this because this is where your consumer instinct can come in so handy if you tap into it. My husband and I were in New York. I live in Santa Fe, New Mexico. So they started a nonstop flight from Albuquerque to New York, which was kind of unheard of because it's really a pain to get to the East Coast. It's really a pain to get anywhere from New Mexico, but that's another story. So we had flown JetBlue. When we got to New York and we were waiting for our plane back, we were in the brand new JetBlue hangar. And they had fabulous restaurants. It was clean. It was bustling. They even had sushi. I'm like, oh my goodness, I wonder if JetBlue's really getting to explode. I went back to the charts and I saw, guess what? It had been in a negative phase. It got into a recovery phase. At this point, this was probably our 3rd time in. It was in a bullish phase. So we waited for it to cross the 10. We risked down here. We got out when it started to sell off. We made some money along the way. Now, by the way, JetBlue is trading at $26. So when I say sometimes, you get that consumer instinct and you say to yourself, gee, I should really continue to track that company, use that. There are books written about that very thing. And if you go into Kohl's or you go into any store, you go into any situation, you say, this is a trend that I think, let's take Apple, for example, that could continue because this is a hot company. Now you have a way to understand, not to buy it blindly, but look to see what phase it's in and look to see what your risk is. All right, here was another situation. This is Kihu. Kihu, again, had the golden cross, but I liked this golden cross. Why? Because even though the 200 slope was still moving sort of south, the 50 was going up, so I knew this could play catch-up, and at the very least, I had a super tight stop. I actually took a little bit profit here. I started to reduce the position size, and then when it broke the 50, I got out of the rest. Now, was it predictable that it might break the 50? Yeah, and you know why? Look what happened to the 200. So even though the 50 was going up, this was now starting to decline. So that's why I say position where the 50 is relative to the 200, slope, super important, and then price so that you can ascertain your risk. Now I want to show you a couple of losses because nobody makes money all the time, right? The whole idea is risk reward. I like to use about a 2 to 3 to 1 ratio. So in other words, I don't just ask myself, gee, this just changed phase and I want to get long or I want to get short. And I don't have any short examples in here today, but we go short plenty of times. I really want to ascertain where do I think this is going to go. Because I don't want to just say, oh, this is a low-risk trade, we'll see. I kind of want to do a little analysis here and think about things a little bit more carefully, whether it's historical chart points, it's a weekly chart, it's a monthly chart, or maybe I just like the company. SodaStream. We got one as a gift, and I thought, okay, a way to make a carbonated beverage that's cheap. I'll check out this company. And so it's exactly what happened. Saw that it was trading above the 50. We got in. It chopped around. I didn't like the action. It wasn't getting the momentum. We got out. And obviously when it broke the 50, we got out of the rest. So we actually, on the second part, well, on the first part, we basically broke even. On the second part, we took a small loss. And that was it, 1.8% loss. Now, the whole idea, though, is for you to understand one thing. Don't use your emotions, don't use your hope, and don't use your, I really want to make money, your greed factor. Use the charts. I didn't think about it. I was like, wrong, it broke the 50, let's just get out, we'll reassess. If you're a relatively active trader, of course, that gives you an advantage to be able to get in and out of things more rapidly. If you're a longer-term trader, still watch your chart and get out. Use those stops, stick to the stops. You can always get back in. Here's another loss, Schlumberger. With Schlumberger, I was pretty convinced that after all this activity to the downside, once it broke up the 50 and then came back, I was like, oh my God, look at that. I'm so patient. I'm going to be rewarded. The 50 was starting to slope up right here when we got in. The 200, by the way, was still up here. It was still in a negative phase. I got in, and you know what? The next day I got out. I could see the momentum to the downside was starting to build, and I was like, this ain't ready. We're gone. So, this is, I hope what I showed you here is whether we're looking at the modern family charts as I showed you before for the opportunities to go short, or in the examples that I showed you to go long, if you look at the overall market and you say the market is in an overall bullish trend, this is going to be pretty easy. Yeah, you're right. If we look at the market and say it's an overall bear trend and things are going to get a little dicey, maybe I want to shorten my time frame here, find things going counter, or learn how to go short, yeah, that's a good thing. If you just wait for those phase changes, at least you know one thing. You have your lowest risk, and then when things start to go in your direction, use your targets, scale out, stick with the trend if it continues, keep raising up those stops, and don't let winners turn into losses. There's a tremendously sort of an oxymoron of trading that happens to a lot of people, especially new traders, which is they start to make money and psychologically we all think, oh my God, I can't believe it, I'm making money. I better get out. I better take my profit. And just the opposite, oh, I got into this thing, it's going down, it's going down. You know what, I'm just going to keep holding. I'm going to keep holding because eventually it's going to turn around. I just know it, I just know it. And those are the people who never live to trade for a very long time. Okay, now there is obviously a lot of other factors that you can improve your trading and your tactics with that I didn't cover today. I love chart patterns. I showed you those point and figure charts way earlier. I love to look for flags and periods of consolidation and wedges and things like that. The whole point of this today, though, was to show you that you don't necessarily need to be an expert chartist. You can use that as a layer if you happen to know, not necessary. Where to place your stops, I gave you a general idea about using maybe 1 to 2 times the multiple of the particular range of that instrument and use those moving averages, but clearly we can get even more precise. Where to place your targets, I told you to use maybe at least 2 multiples, 3 multiples, etc. before you start taking your profits. That can be more precise. Moving your stops definitely can be more precise. Whether you should focus on ETFs, as in the modern families, or individual instruments, again, things going counter, looking at those major sectors and groups, groups can get more precise. There are ETFs now, have become such a popular thing to trade. I love trading them. I trade them all the time. Commodities, by the way, is something that I'm really keeping an eye on. Again, if you sign up to read my daily stuff, I've been talking a lot about commodities lately. And then position sizing, I gave you a general idea, but it's very specific. And of course, managing your positions along the way. All of this is more specific and more tactics that you can learn over time. But hopefully you're walking away today saying, gee, if I just know where the 50 and the 200 is, I know what the slope is, I know where the price is, I can at least have a lot more information than probably what most of the pundits out there and most of the media people are telling me. So, I want to make sure I have time for questions. I only have 5 minutes left, so I'm just going to tell you real quick on this. And again, third person, I apologize for that. But we have a service, this is Advantage, full year. I'm your mentor. Again, it is both an educational and a recommendation service. I give you one trade set up based on everything I just showed you per week. I'll skip weeks. Before the August crash, we went to cash. We didn't trade for a few weeks until we saw what the dust settling might lead. I also do videos every week, and you get that with all this analysis. You get ETF recommendations more than what the free people get in the daily. And so you learn by example, but my idea is really to teach you to identify. So you have access to me. I will answer questions to you in emails, etc., about phases and what you don't understand. If you give me something you want me to look at, I'll tell you what phase is in. And basically, I can't give you a trading recommendation, but I can give you information in an email. Of course, on Twitter, I can be a little bit more specific. And so we're doing that service with this accelerated course. It's called Fast Track. It's 8 modules where I talk about a lot of this stuff. This you get to keep. And all of this, basically, if you divide it up into its individuals, the Advantage, the Fast Track, it comes to this. But right now we're offering it for a full year for this. And again, I'm going to give you the link in the chat box here. If you want more information, or you want to take a look, or you want to sign up, here it is. If you want to ask questions, please feel free to do that about the actual service. I really rather spend my time answering some questions for you. So here it is in the chat box. If you go to that link, that gives you all the information you need. Okay, I have so little time left, but let me see what kind of questions I've got here. All right, so some analysts expect a bigger drop than last August. Is coming very soon. Any thoughts? Well, you know, I actually, if you look at the charts right now, particularly what happened on Friday in IBB, we're at very key weekly and monthly moving averages in a lot of different areas. And so essentially, I would say that if we cannot hold these weekly and monthly moving averages, and by the way, I actually have that in this daily, so some of those numbers listed for you, then I would say, yeah, it does look pretty dicey coming up in the next few months. And so there's a couple of things to watch to see, make sure that, you know, KRE would be one, IBB would be another. It's about to get down to a very key weekly moving average. So far, most of everything that we talked about haven't broken their 200 weekly moving averages for the long-term trend trading. If those hold, then we might see a bottom there. If we get a bounce, it's weak, and we break those 200 weeklies, we're in for some nasty times. Okay, so let's see. My book is called Phased, P-H-A-S-E-D, not confused. And when it becomes available, if you sign up or you sign up for my daily newsletter, we have your email. That's how we'll announce that the book is available. Is there no link in the box? I see MarketGate. I put it in. I don't know, Jeanette, if you put it out there for everybody. So please take a look and make sure. Let's see. Can I show the slide with the family members again? Sure. I'm sorry, Jeanette, what did you say?
Oh, sorry, I had put my headset up too high. I'll go and make sure I put it in the chat and in the Q&A part.
Okay. Somebody asked me to put up the. Oh, here we go. Here we go. This is the one. So it's Russell's, biotech, retail, semi. Somebody asked me before, why do I use SMH? It's just a very heavily traded, good volume, good liquidity. That's why I like that. That doesn't mean that you can't choose one of the others. I just find consistency for me works. I like to do the same thing over and over again. Transportations and regional banks. Yes, you can trade options with these. Michael, absolutely. Especially, look how clean that is. So let's say you wanted to go short and you wanted to buy some puts. You could have bought the 122, the 123 puts in IWM, and you would have had money very quickly. So I do encourage, if you know how to use options, to by all means use them. I do not use exponential moving averages anymore. I have stuck to the simple ones for the ones that I do. When I trade currencies, generally I do it through ETFs. So that's the reason why. Thank you. Somebody said excellent presentation. And that's the person who asked about XLK. If you want to use XLK, go ahead. I like SMH. It's a simple 10-day moving average. And on SOTA, I had the stop just under the 50 daily moving average. You can see that I made a little bit of money and then, well, actually I scratched and then got out. Hold on. How long have I been practicing the phases? Forever. When I was on the floor, I didn't know about things called phases, but you did know about cycles just as a commodities trader because they're very seasonal. So it was really our first glimpse into being able to interpret using commodity cycles and seasonals into actual measurable phases. Okay, how about showing loss? I did that. Mosaic got me. Okay, so I think that's pretty good here in terms of, I hope I answered most of your questions. We are at time to be done. Thank you. I'm glad I made this simple and understandable, and I do really have a passion for what I do. The biggest thing is I really want to do as much as I can to try to help people and protect people. When I started on the floor, there were guys like Paul Tudor Jones, Mark Fisher, a couple of other guys that are really super famous. And you know what? They took the time to help me, and I'm forever grateful for that. And that is just something that I continue to pay back on an everyday basis. Follow me on Twitter at Market Minute. I give specific trades on that very often. Sign up for the daily at marketgauge.com. And if you liked what you heard today, please, I encourage you to try the Advantage service. And if you have any questions, Mish at MarketGauge is my email. Jeanette? Well, I don't know. Okay, I'm kind of done. I mean, I can still answer more questions as I'm not being cut off. But I really thank you guys for coming today. Thank you, Jeanette. Thank you, Hubert, for inviting us. I really am happy to read these things. Thank you for the presentation. You can do Forex with us, absolutely. The way you find the Advantage service is, again, it was in the chat box. It's www.marketgauge.com/trade, and you can find it there. Do I use the ES and the E-minis? I mostly stick to the SPY, actually, but that doesn't mean you couldn't use this for E-minis. I just use the simple moving averages because I find it's the clearest for the phases. That's really the bottom line. And again, I have really been working on this presentation for years to bring you what I was saying before, the simplest curriculum modification, as if this was a high school curriculum and now we were going to teach it to kids with a bunch of learning disabilities and we needed to pull out the simplest, most concrete, and most salient points of where to get started. I haven't seen or found anything better, and you know what? When I go back and teach this and I realize I've made some trading mistakes, it's because I've wandered from this. So that's why, for me, personally, it reinforces all of this. You get trading recommendations one a week, sometimes twice a week. Sometimes I'll skip a week. If I don't like the way things are set up, I'll wait for setups. So, Jeanette, I'm not quite sure what I'm supposed to be doing here because I'm chattering away here and I know I'm past my time limit. What do I think? Do you think IWM leads the market? Absolutely, I do. It may take a little time for others to catch up, but back before we had seen other corrections, we've seen like IWM have double tops. We've seen IWM go into weaker phases first, and may take a little time for others to catch up. You know, there was a real diversion there for a while. The Qs were still going higher while IWM was starting to break down. But eventually, if IWM can't catch up to what's leading, then IWM will absolutely show you well ahead of time that things could go down. I like, yes, transportations, semiconductors are said, retail. Watch that retail. The August 24th crash, we're not too far away from it now in many, many instruments. So let's see what happens in the ones that are closest. See if they can actually hold up. A typical track record percent per year, well, we were up in my premium service, which is now run by an automated trading model. We were up over 40%. This year in the Advantage service, after being up much greater last year, we are outperforming the market. We're down a little bit, but we're only down like 2%, so we're maybe one trade away from getting back to the positive side, considering the market's down 7%. That's pretty darn good, especially trying to pick one trade a week. Not so easy. Would you mind showing, I showed the Modern Family. What do you think of the divergence of the, yeah, yesterday. Interesting question about the divergence between DIA and IWM. I wrote about this because, you know, if we're going to see the market hold here, watch that down. This is a very, very important question. Because if the Dow breaks down, the DIA breaks down under 162, there's minor support at 160, but really it's not until we get down to some of those weekly moving averages that we start to see the major support in the lower 150s. On the flip side, though, if we open up, even if we open up lower on Monday, which many people predict we will just by the weakness we saw on Friday, and then it climbs back over 164.50, and make a note of that number, that actually could help the rest of the market. So, you know, what do you want to do? You want to find, if you're interested in buying a bounce, if the market holds, try not to buy weakness. Try to find the ones that are in recovery or bullish phases. And there's quite a few out there in terms of individual instruments. And I will say commodities are starting to try to base out. Sugar went into a recovery phase. Corn went into a recovery phase. We're still a little bit far away in some of the others, but coffee had a 4% move off of the lows. So watch your commodities. The two commodity indices that I like to trade the most, if you want to do a whole basket, is DBC, that's a D, sorry, DBC. That one is the metals, oil, and corn. And then there's DBA, which is the agricultural basket. I've been writing a lot about these. The DBA of particular interest right now because the 2008 low was 21.52. We've broken under that here 7 years later, and things happen in 7-year cycles. But on Friday, it closed at 21.13, which means if it can continue to hold and take out this number, I think we could see all these deflationary fears. We can actually see some inflation coming in terms of the agriculturals. I think the gold looks solid here. If it holds, silver as well. Palladium made a tremendous move. So my point is whether you're doing commodities, or you're looking at individual equities that are still bullish, like Amazon, Tesla, Google. No, Google actually broke the 50 on Friday. Panera is another one. I talked about that recently. If you find those that are close to their moving averages, but they're in recovery or bullish phases, and you think the market can bounce, go for that. The oil, okay. Actually, if oil gets over 15, and I'm looking at USO, and if I would have known I was going to get all these specific questions, I would have put up my TradeStation chart. So I'm just going to talk from memory here. If USO crosses $15 and holds 14, I think that's your parameter. I think oil could actually go up. And also seasonally, you know, I know that heating oil starts to get more attractive at this point of year. I think through all the negative noise that we've heard and all the predictions of it going to $20 a barrel, it's held up pretty well. So I know that there are some pretty smart people out there thinking oil could go higher. Again, if you just look at the charts, gets over the 50-day moving average, confirms in a recovery phase. That's all you need to know. You take your hit. If it breaks it down, you get out. And if it holds, you may even have to probe it a couple of times. And especially if it can clear some congestion here and clear 15, I would take a shot long, absolutely. Okay, rig counts dropping in natural gas. Yeah, take a look at natural gas too, Laurel. I know you, Laurel, don't I? I know you through, yes, through Susie. Yeah, hi, nice to see you. And Market Gauge, that's right. Francis, I know you too, actually. I've seen your name before. Do I think the U.S. is already, in terms of dependency on foreign oil, has gone way down? We're already becoming an exporter of oil, and that's a good thing. By the way, that was a goal ever since Nixon's presidency. You could hear talk of, we want to become, more oil independent, and we have. This is the first time we actually have. UNG is very interesting for natural gas, by the way. It made new lows. It looked like it was holding that low on Friday. If that starts to come up a little bit, by the way, you read all about this in my daily. So how did I know to get out in August before the plunge? What I just showed you with the Modern Family. This is right here. I mean, I've got a lot of writing on it right now, but you can see everything was breaking down and it wasn't bouncing. And we tested moving averages and it still wasn't bouncing. And I'm talking about right in here. This is the August plunge. So I knew once the IWM couldn't break the 200, once the IBB started to break the 50, which was the strong one, once retail broke the 50, semis were already broken down, IYT was starting to have a downward slope, and transportation and also the regional banks, which were the strong ones, were breaking down. I didn't know we were going to get this level of move, but I knew something nasty was coming. So rather than be a buyer, and if you didn't get short right at the top here, I just sat it out and went to cash. Gold 1,000 or 14. You know what? If it gets through GLD, gets through 110.25 and holds, I'm going for 1,400 before 1,000. That's just my prediction there. Yes, we do use inverse ETFs, absolutely. Okay, I'm not sure why I'm continuing to go on here. Maybe, Jeanette, is because you want me to be answering all these questions.
Oh, it's totally up to you. I don't know what your schedule's like, but I'm just sitting here working, and I would say, maybe for recording's sake, maybe take another 5 minutes worth, and then remind them of your offer, and then we'll close it down and go have a Saturday.
Oh, okay, great. Well, thank you. I'm getting such nice feedback here. We love you. I love you too. Great job.
Your own thing, honey. Just do it.
Continue to teach. It's great listening to you. Great, thanks. What did you say you expect to see at 1,400? We were talking about GLD. Oh, well, GLD, that would be trading at 114. So that relates to the cash gold at 1,400. My book talks about cycles. My natural proclivity is to be a bull. I mean, I like when things go up. That's a happy time. I find bear markets very hard on the psyche, and it's just not good. I mean, you could see that it also lends the stage to a lot of fear-mongering by the media and by politicians. And I mean, they're fear-mongering even when the market was in a tremendous bull market. But what it does is it really becomes insidious to the human psyche. Oh my God, things are going down and everybody's telling me the world is the worst place it's ever been, ever, ever, ever. Well, you know what? The world has always been a hairy place since the beginning of time. So I find bullish markets just are a lot easier to wake up feeling cheerful. It's not so cheerful to see a down market unless you happen to be just a natural pessimist. I happen to be a natural optimist. Okay, been watching for a long time, made tons with your simple approach. Thank you, Fred. I think there is a recording. Jeanette can tell you more about that. I will put your Modern Family charts on my trading daily routine. The bull moves grind, but the bear drops are big money movers for damn sure. Things go down. You know, they say, right, what's that expression? The stairs up and the escalator down? Or is it the escalator up and the elevator down? Any particular sector you like now? Of the Modern Family or in general? Of the Modern Family, I'm looking at KRE as our best hope. What's interesting here is retail has done a lot of damage, but if it can hold around 45.34 area by the end of this month, then it's held a very key monthly moving average. But I would keep my eye on the regional banks and, of course, on IWM. That has to hold up. I don't care what else happens in the market. If it can't, that it does not bode well. And really, for that question, I'm going to say, Guy, commodities. I can't talk about it enough. Commodities, commodities, commodities. It's where I cut my teeth. I'm actually in the advantage right now, long sugar. And I plan on staying long sugar, and I'm watching the metals, I'm watching the oil, and I'm watching that DBA and that DBC. We do not have positions in those yet, but I would have absolutely no problem doing that. Do I look at any of the volatility? Yes. Right now we are long SDS, which is not in the advantage service. We have 5 services altogether. Market Gauge has been around for a long, long time. We have technology and software, financial information software. We have 4 automated trading services, one of which is a country fund, ETF sector fund, a global macro fund, and then we have the NASDAQ All-Stars, which takes the top 5 NASDAQ stocks and trades them long, and then and that's all weighted. And then we have a pendulum profit system, which is an active trading model, which is both long and short. That model has well outperformed most of the ETF country fund model and sector models. I think are majority in cash, but they're long VIX, they're long SDS. And yeah, so I just mentioned we actually are long VIX. We're not doing it through options, we're doing it through the VIX itself. We do leveraged ETFs in our sector and global macro models. Absolutely we do. We do the triple ETFs. Is the asset management for high net worth accounts? Well, actually, that's an excellent question. I would love to answer that question more specifically. We're going to actually be doing a Reg D account, which means we can take much smaller amounts of money. You do not have to be an accredited investor to for a limited amount of money. We're going to do these Reg Ds. So you don't have to be an accredited investor to invest there. Having a plan and keeping to a plan is where discipline comes in. Absolutely. Discipline is the most important thing. Where do I see Netflix going? You know what? Let me put up a chart. I haven't traded Netflix in a while. We were long in our NASDAQ model. We got out with a profit and then got stopped out of the rest, I think either at a break even or a small profit. Well, let's see. So exactly I don't know, I should have shown my charts. I'm sorry that I didn't know that I was going to be on for so long. But the 50-day moving average is pointing down, very far from the 200. It's been trying to dance around the fast moving average after breaking under the 50. So here's what I think about Netflix right now. It looks relatively heavy to me right here. I have to say, if I had to make a guess, I would say more downside. But like everything else, with a 200 daily, that's still holding up over its 200 daily. And Netflix currently, by the way, is in a warning phase right here because it's under the 50. If it breaks back over the 50, which is around 110, maybe it'll take another stab at 120 or so. If it breaks down here under around 100, I would say it's so entirely possible you'll see that August low or maybe even lower down to around the 200. IBB, well, you know, what's interesting about IBB is that we broke a very important weekly moving average. With IBB, we have broken down under the 65-week moving average, which we haven't done since the summer of 2011. So that was 4 years ago. That's a pretty significant breakdown. The next major support on a longer-term chart is 294. So that's a 23 monthly moving average. That's a 2-year moving average. We're still holding that. So with IBB, if we cannot get back over that 65-week, which is around 321, 322, then I would say that we'll probably see that monthly moving average tested. If last week was just a washout, and let's take a look at the volume on that. Hold on. The volume pattern on Friday was big. So in other words, where the normal volume is 22 million shares plus, On Friday, it was 90 million. That's almost 5 times, excuse me, 9 million. Let me say that again. I'm looking at, there's a lot of numbers here. The normal volume for this ETF is 2,227 is the normal volume, so 2 million shares. On Friday, it was 9 million shares. So that's over 4 times the amount of volume normally. Okay, so what that tells you is that not only could that have been a blow-off and you have relative strength very weak, it's showing oversold. If it is indeed a blow-off, then you've got to look at that 320, 321 level. If we can clear back through there, I don't think any of these are going up to new highs anytime soon, but it does mean we may be able to see another bounce up to around that 340 level, which is really where it broke down from this week. And if we can't make a decent bounce and we cannot clear through 321, then the volume and the oversold condition just means that it's really deteriorating. We may work off the oversold conditions, we may chop around, we may even consolidate for a few days. But again, if we can't get through 320, then I would say it's not unrealistic to think we're going to test that 23 moving average down at 294. Okay, let me take one more question, guys, because, well, it's just been a long time, and you should never overstay your welcome, right? So, do you think with the timing involved that this market will take a few months to play out? Yes. And typically, by the way, September is usually a crappy month anyway in the market. It has been historically. And if you go back and look at 2011, 2013, October, November was not so great. And so it's possible that this is the correction that was long overdue, seasonally coming in at the right time. And then as we get closer to the holiday season, and who knows what the Fed is going to do, that's going to be a factor right here as well. First they say they're never going to raise rates. Now they're saying they probably will raise rates. Again, watch all these factors. Watch China. Super important, because if China ETF, and I look at FXI, starts to go down, well then, again, it's going to be hard for the United States to reckon that even with some good economic numbers that we can hold up. So, you've got all these little clues, but mostly, since you can still see the chart of the modern family, watch my modern family. Watch to see what breaks back over the 50-day moving average first. Is it going to be semiconductors, which tried it a couple of weeks ago? Is it going to be IYT, which was above it and now below? Can KRE, which is not even bearish yet, still in a distribution because we haven't had a death cross back over its 200? Can IWM get over the 50? Can IBB recover? That's got a long way to go. Or XRT. If I had to say which ones I would probably feel the most confident and maybe this was it, or we're getting close to being this is it and we just chop around and then we start to see fresh buying coming in. Maybe China does better, although everybody's expecting them to devalue their currency even further. Strong dollar here can also spell negative for certain things, positive for others. But keep your eye on XRT. That's just my gut right here. My gut is telling me that of the modern family, we need retail. We need consumers to come back in. We need to show some consumer sentiment to the positive side, and we need to have this holiday season coming up being matched with buying as opposed to I'm saving money and I'm not going to spend a lot of money this Christmas and holiday season, and that's not going to be good for 2016. And of course, we've got a presidential election coming up. That always makes for some fun too. That is usually I have some idea in my mind of who I think could be the next president of the United States. I got to tell you, I have no clue. Zero clue. This is the most interesting presidential race I can ever remember in a very long time. So you think that the 2015 season will be below the 2014. That's probably true. Probably true. But watch retail. Our slogan at Market Gauge is don't guess, gauge. I just gave you a way to gauge. Watch that 50-day moving average and a phase change to something more positive, considering retail's now in a bearish phase. And that will give you all the information you need to know. All right, that's it, guys. I'm gonna call it a day. I'm so excited you all wanted to stick around and ask me all these questions. Again, a great way to talk to me more and hear my thoughts every week is join the Advantage. We have many other services if you want to go to MarketGauge. And at the very least, follow me on Twitter at Market Minute and also get my Mish's Daily. I try to write with a sense of humor, make it funny, make it palatable, use a lot of metaphors, and give you a lot of valuable information. So again, Jeanette, thank you, thank you, thank you. Hubert, hope all's good with you. We'll have to catch up one of these days. Thanks again. And thank you
Sure.
all.
Hey, can you mention your link one more time? Mention your offer link because I didn't post it in there, so I want to make sure I give them one more chance to see it.
I'm going to put it in the, yeah, I will. I'll put it in the
box,
chat
maybe.
box.
Okay.
Yeah, put it in the chat box
Cool.
right now. .com/trade/ let's just make sure I wrote that right. I did. There it is. Can you see it?
Yes, I see it.
Okay, good. All right, cool.
Great presentation. Thank you so much for being here with us today, and have a great rest of the day.
All right, somebody's asking for my Twitter handle as well, and that that at Market Minute.
Yeah. Okay, gotcha. I wrote
All
that
right.
down. I'm going to follow you.
Oh,
All
great,
right.
great. Thanks, Jeanette. Thanks, everybody.
You're welcome. All right, everybody have a great day, and Mish, thank you so much. I'm going to take back real quick the presenter status from you.
All righty.
All right, have a great weekend.
You too. Bye-bye, everyone.
All right, everybody, thanks for joining us today. We did record, and we hope to get that out to you in the next couple of days. Our next event, go ahead and mark your calendar, is going to be set for October the 28th, October the 28th. And I've got a great lineup for that one, and it'll be all new people. So hopefully y'all can make it. That's an evening event on Wednesday, October the 28th. Watch us at TradeThirsty.com, and you can see all the details there. We'll also post the recordings there. And you can even go there now and see recordings from last month because we haven't posted today's yet. So anyway, y'all have a great weekend. See you soon.